$6.88 in earnings per share usually triggers a massive Wall Street rally, yet the smartest institutional money on Wall Street is quietly bracing for a brutal fundamental shift instead. Qualcomm just reported a seemingly spectacular financial quarter, but does this report represent a genuine triumph or an illusion masking an operational collapse? When you look at the staggering $5.7 billion in tax valuation allowance release, the reality of this quarter instantly fractures. Mainstream analysts are cheering because Qualcomm reported a massive generally accepted accounting principles earnings per share of $6.88. They see this explosive 162% surge in reported net income and immediately assume the stock is a screaming buy. But when you strip away that one-time accounting windfall, true operational profitability tells a much darker story. For Qualcomm, the non-generally accepted accounting principles, net income actually contracted by 10% year over year, dropping to a sobering $2.84 billion. Retail investors screening for standard price to earnings ratios are walking right into a devastating valuation trap. They perceive an artificially cheap stock while completely missing the underlying pressures eroding a core business that just lost 10% of its adjusted profit. But why is this underlying profitability actually sinking beneath the surface? That brings us straight to the Qualcomm handset segment revenue, which suffered a severe 13% year-over-year decline, falling to exactly $6.02 billion. The Qualcomm handset segment tracks the sales of processors placed directly inside modern smartphones. On the surface, the market suggests Qualcomm is simply experiencing a mild cyclical dip before a $6.02 billion recovery. But the real twist hidden in the data is that memory supply disruptions and elevated component pricing are actively choking their legacy handset revenue engine. Qualcomm remains heavily dependent on a concentrated cluster of premium smartphone manufacturers, leaving them violently exposed to regional market volatility, where much of that 13% revenue decline originated. When Qualcomm handset segment revenue bleeds this quickly, it signals a systemic bottleneck rather than a brief pause. This brings us to what they are forced to spend just to survive this painful industry transition. We see the painful cost of this pivot clearly when examining the gross margin, which contracted to 53.8%. Gross margin is the revenue left over after subtracting direct manufacturing costs from that $10.6 billion total. The broader market might dismiss a slight dip in their 53.8% gross margin, but the devastating narrative tension lies much deeper in the operating margin, which plummeted by a catastrophic 660 basis points down to just 21.8%. This severe compression is the direct result of shrinking top-line revenue colliding with a 10% increase in research and development and a 27% spike in administrative expenses. Management is deliberately destroying their near-term operational leverage to aggressively fund their desperate pivot into future technologies. But where is all this aggressive research capital actually going? The answer lies in the Qualcomm automotive segment revenue, which just exploded to an impressive $1.33 billion. The consensus in everyday stock market analysis is that Qualcomm is just a legacy phone chip company with a minor side hustle. But when you witness a massive 38% surge in automotive revenue paired with a resilient 9% growth rate in the Internet of Things sector, the fundamental thesis changes entirely. The Internet of Things sector covers chips for smart appliances and connected devices, adding another solid growth pillar to support that $1.33 billion automotive division. This data proves that Qualcomm's core architecture can successfully escape dying mobile devices and dominate high-margin next-generation vehicle ecosystems. If this trajectory holds, these new growth pillars will permanently reduce their toxic dependence on handset upgrade cycles that cause that 13% drop. You must stop valuing Qualcomm like a mature telecom supplier and start pricing it as an emerging automotive technology powerhouse. The golden rule is that successful diversification, like a 38% surge in automotive revenue, cures cyclical decay. But before we celebrate this pivot, we have to endure a painful reality check hidden in management's immediate forward projections. That reality check hits hard with the third quarter revenue guidance, firmly set between a low of $9.2 billion and a high of $10 billion. Forward guidance is management officially predicting how much money they expect to make in the next 3 months. The retail crowd assumes a recovery is right around the corner, ignoring the midpoint of that $9.2 billion to $10 billion range. But this conservative outlook reveals a clear sequential step down from the second quarter revenue, which previously printed at a much stronger $10.6 billion. This downward trajectory from $10.6 billion confirms a terrifying truth about consumer hardware. Handset demand has not yet reached its cyclical bottom, leaving the company heavily exposed. Investors are forced to weigh the distant promise of a late-year recovery against the brutal reality of another quarter, defined by sluggish demand impacting that $6.02 billion handset division. As an investor, you must brace your portfolio for severe price volatility in the near term, as the old mobile revenue engine causing that 13% drop continues to misfire. Yet, despite this near-term operational pain, the company possesses an extraordinary financial shield. That ultimate defense is showcased by their phenomenal free cash flow, which surged to an unshakable $6.33 billion. Qualcomm is generating a monumental mountain of cash despite the severe operational headwinds blowing against their 27.7% margin. Leveraging this immense financial cushion, the board just authorized a staggering $20 billion share repurchase program to supplement the $3.7 billion already returned to shareholders. By aggressively buying its own stock, Qualcomm signals tremendous executive confidence that current shares are severely undervalued relative to their cash generation capabilities. It culminates in their strategic entry into the cloud space, looking to supplement that $1.33 billion automotive revenue with custom silicon shipments to a leading hyperscaler later this year. A hyperscaler is a massive cloud provider operating giant data centers to power modern applications. By leveraging their high-efficiency architecture, Qualcomm is opening an entirely new total addressable market to supplement their $1.33 billion automotive division. This milestone forces the market to completely re-rate Qualcomm from a stagnant mobile player constrained by a 13% handset drop into a critical infrastructure provider within the artificial intelligence build-out. This is exactly why your portfolio feels the gravitational pull of these fundamental shifts, moving away from a 53.8% gross margin hardware business into enterprise services. Catching a company precisely when it breaches a new enterprise monopoly is where generational wealth is forged, far beyond a simple $6.88 earnings beat. But I want to hear your take on this massive $20 billion transition today. Do you think Qualcomm's strategic pivot into automotive and enterprise artificial intelligence will ultimately save them from a dying smartphone market, or are they fighting a losing battle? Let me know in the comments. So hit subscribe so you won't miss what's next, and jump straight to the next video, because that could be the very insight you need to get ahead.